Ladies and gentlemen, welcome to our investing podcast. Our guest on the podcast today is Dr. Wade Pfau, Professor of Retirement Income at the American College of Financial Services. He holds a Ph.D. from Princeton University and is a CFA charter holder. Dr. Pfau also writes on his blog on retirement matters, retirementresearcher.com. You can check the link below in the show notes. He also works with McLean Asset Management to incorporate his research on retirement income planning into practice with clients. We're excited to have him here today. Dr. Pfau, thanks for coming on the podcast.
Well, thanks for having me. It's a pleasure to be here.
To begin with, I would like to discuss about William Bengen and his latest quote. He says the following: I believe a distinction must be made between timing the market and risk management. I agree that picking tops and bottoms consistently is impossible and not worth trying, but adjusting one's allocation tactically to reflect higher market risk makes sense to me, particularly for retirees. Why would one wish to be fully invested in stocks when valuations are at all-time highs by many measures? Inevitably, a large decline will ensue, and there goes much of your capital down the drain. And we now have these two schools of thought. One of them says because equity valuations are expensive, therefore risks are very high at their peak. Even Howard Marks says move forward but with caution, and therefore you should lower your equity allocation in this environment. And the other school of thought says because equity valuations are expensive and future prospective returns are at the lowest levels maybe in their history, therefore one should take on more risk because he needs to do that in order to get the same return as before. In which camp are you?
That's a good question. So I've experimented with looking at that type of changing asset allocation in response to equity valuations. In US historical data, that sort of approach had worked traditionally up until the late 1990s or so when people started to look at it in the first place. In more recent years, the stock market valuation has been the values have been overvalued relative to historical norms, so that since the late 1990s, with an exception of around 2009, people generally would have used a lower equity allocation than otherwise because of the high valuation levels. So I think in recent years, it hasn't worked as well as the historical data suggests. And I've really moved away from trying to think about asset allocation and changing it in response to equity valuations. Instead, I still worry about high equity valuations. And I think the remedy is to just build a plan that can work with a lower future market return, just to deal with the possibility that market returns may be lower in the future. But I don't really think someone should change their equity allocation just based on equity valuations, because again, though historically that would have led to some improvements, it's been a losing strategy over the past 20 or 25 years, just because valuations have stayed high. And there could just be all these other factors, such as low interest rates, that help to justify a higher level of equity valuations today.
We have also a question from our investing community. What is your view on inflation, which seems to be a hidden robbery from our purchasing power parity today? And also, how should a young man protect his assets in this environment? If he had a 100,000 euros lump sum to invest today and keeps that money into cash, since we are facing two evils. On one side, we have this inflation risk, which is increasingly higher than average, but in the same time, we have sequence of return risk, which is higher in periods of expensive equity valuations as well.
Mm-hmm. So if this person's already retired, they have to be more concerned about the sequence risk implications. But if it's a young saver, they're not yet at a period where sequence risk will become a big issue. It's really more a factor in the years just before retiring, and then especially in the early retirement years. Now, bonds historically have not provided protection from inflation. So and that would include cash. It's just cash is not yielding anything. And so inflation will eat away at the purchasing power. Historically, though it's not a perfect relationship, but we would expect equities or stocks to hold up better against inflation, not necessarily in the short run, but over longer holding periods. Eventually, as inflation allows for the firm's revenues to increase, that should eventually, hopefully, be reflected in equity prices. So for longer term investors who are seeking protection from inflation, again, it's not a short-term relationship, but over the long term, equities should be able to better provide inflation protection, certainly than bonds. And then to the extent, so now in the United States, just since the late 1990s, we've had TIPS, which are Treasury inflation protected bonds that provide a real interest rate plus whatever realized inflation is. So these bonds can also provide a source of protection from unexpectedly high inflation. If that exists around the world in different countries, that can be an option as well. But to the extent that these are not universal and you don't necessarily want to invest in foreign currencies in a high inflation environment, because that can lead to, that can lead to a depreciation of the home currencies. I guess I'm saying that a little bit backwards. For local investors to take on interest or the foreign currency risk, if high inflation leads to a weaker currency at home, holding foreign assets can help to accommodate that as well. So actually that would fit in as part of the stock category, holding domestic stocks, hoping for those will keep pace with inflation, holding international stocks, and then managing some of the risk of a depreciation that way through that is caused by inflation, holding inflation protected bonds, but certainly the traditional bonds or cash are not going to be good ways to keep up with inflation.
We often discuss about sequence of return risk when it matters the most in retirement, because most young people have plenty of time ahead, and also most of their capital is stored in human capital. However, for someone who has no human capital receiving an inheritance today, given the expensive market valuations when sequence of return risk, as I said, is higher, would you still choose to dollar cost average that amount for at least 2 or 3 years to avoid the regret of investing at the market peak?
So this is an issue where they're receiving an inheritance and now deciding what to do with it. Traditionally, markets go up over time. And so that would lean towards just investing the lump sum right away. But you do make a good point that, especially if you're close to retirement, investing it all right away and then experiencing a subsequent market drop can be quite a risky endeavor. And so I guess you could think of investing that over time and dollar cost averaging that into the market as a way to help manage that sequence of returns risk. So then ultimately it's going to be linked to an individual's risk tolerance. It would help reduce some of the risk, but potentially also, if markets do well, as they historically have done, lead to a lower return as well to dollar cost average that in over time. So you could view that as a risk management technique to take some of the risk and some of the potential return off the table.
Which would be the maximum or optimal time horizon for using a bond tent without losing too much purchasing power?
So this is for a retiree who's thinking to use some sort of time segmented strategy where they hold bonds for short-term expenses and then use stocks or other growth assets for longer-term expenses. And then the idea of a bond tent specifically is if I have, say, 10 years of expenses covered in bonds, and then I just spend those down without replenishing them, I'm starting with a lower stock allocation, and this can allow me to have a higher stock allocation over time. This is based on some research I did with Michael Kitces, where we looked at the idea of a rising equity glide path, that you start retirement with a lower stock allocation and increase that stock allocation over time. And a bond tent provides a way to do that. Now, the specific question is, what is the length of the bond tent that will create the best outcomes for an individual. And there's not really a simple answer to that. It's not something we specifically tried to optimize in that regard. It's just we do know that sequence of returns risk has the biggest impact in the first 5 to 10 years of retirement. And then market returns do not have as big of impact afterward. So that can be a good starting point to think about. A bond tent that would cover the first 5 to 10 years of expenses may help to manage a lot of that sequence of returns risk. And then whether you choose the 5 years or the 10 years or something a bit less or something a bit longer speaks again to this idea of risk tolerance. How much risk are you willing to take? The longer the bond tent is, the more risk averse you are, the less risk you're taking, because more of your assets are going into those bonds, less of those assets are then remain to go into equities. So you have a higher overall bond allocation with a longer bond tent. And so ultimately, that's how you can think about which specific bond tent length to create. But again, somewhere in the range of 5 to 10 years should help to manage a lot of that sequence of returns risk in the early retirement years.
Dr. Wade Pfau, what common retirement mistakes have you noticed to be made by retirees during your research on retirement planning, and how would you define retirement success?
Well, maybe it's easiest to start with the second question, because that can point out some of the mistakes. But retirement success, there's both financial and non-financial aspects of retirement success. On the financial side, it's simply a matter of meeting your financial goals, whether those are making sure you can cover your basic expenses no matter how long you live, whether it's really maximizing your lifestyle in the early retirement years when you're still alive and healthy and not leaving too much on the table by being too conservative with your spending. Whether it's maintaining a legacy goal or whether it's having reserve assets to cover unexpected spending. On the financial side, again, success is making sure that you're able to achieve your goals. On the non-financial side, we know now that there's a lot more than finances at work for a successful retirement. If people don't have any purpose or passion in retirement, that can lead to negative emotional feelings. It can lead to depression. It can make it harder to get out of the house and be active and do things. And it can just lead to a very unsatisfying retirement. So before retiring, a big mistake people make, getting to the other part of the question, is they focus too much on the finances and not enough on the quality of living or what they'll do during each day. The 8 hours a day that they may have spent at work, they have to fill doing something else. And so not thinking enough about what that will be, whether it's to just have it hobbies or activities, doing volunteer work, maybe even doing some type of job in retirement. It doesn't necessarily have to be a full-time job, but part of finding purpose or passion may involve still doing some type of work in retirement, building family relationships, maintaining friendships, and so forth. And just focusing on one's health and other aspects also are very important. In terms of not making that sort of mistake on the non-financial side. In terms of financial mistakes people make, there's a lot of directions that can go into that. Some people may not really save enough for retirement, and so they have to reduce their lifestyle. Some people might oversave for retirement and are so worried about outliving their assets that their money continues to grow throughout retirement, and they end up leaving an unintentionally large legacy well beyond what they might have intended to do. And so it just reflects they could have enjoyed a higher standard of living in retirement, but they're too worried about outliving their assets. Beyond that as well, just not being efficient with thinking about asset allocation, sticking to a proper strategy, considering whether there might be a role for other types of retirement products like annuities that can support a standard of living no matter how long somebody lives and so forth. So those are some of the potential mistakes people might make.
Excellent. Dr. Pfau, you published an article on Forbes.com titled 4 Approaches to Managing Sequence of Return Risk in Retirement. The 4 approaches are spend conservatively, maintain flexible spending, reduce volatility when it matters the most, or buffer assets. While they sound excellent in theory, how should we implement these retirement income styles into practice?
Yeah, so these 4 ways of managing sequence risk, it didn't take long to state them, But I think it really covers any sort of retirement strategy. And so it's really a matter of starting to think about what you feel more comfortable with. The first one was spend conservatively. And that's the logic of something like the 4% rule that Bill Bengen created. It's just this idea of, let's just see how low our spending needs to go so that we're not worried about running out of money. And it's not necessarily the most fulfilling way to manage retirement. And it's also the strategy that creates the most sequence of returns risk, because you never adjust you use a high stock allocation. Bill Bengen called for 50 to 75% stocks in retirement. And then you never adjust your spending in response to how the portfolio performs either. So that if there's a market downturn, you're really triggering sequence risk because you're continuing to spend at the same level. So that's where the other three approaches come into play. Spending flexibly is really important, and it's something real world individuals do. If you can just cut your spending a little bit after a market downturn, that can help manage sequence risk and help to extend the longevity of your portfolio. So different ways to adjust spending. And conversely as well, like if your portfolio is doing really well, you can potentially spend more. But if your portfolio is doing poorly, you might want to make some sort of cut to the spending as well. And that can do a lot to help manage sequence risk and get the most lifestyle out of the investment portfolio. The reducing volatility strategically, bond tents are an example of that, the rising equity glide path and these types of bucketing strategies. Annuities could also fit there. And it's just a matter of whether than maintaining a high stock allocation throughout the entire retirement, you somehow take some of the risk off the table when you're the most vulnerable, either due to the sequence of returns risk or back to the earlier point, if you're particularly worried about high stock market valuations, reducing risk exposure in those scenarios. Those are just different possible examples. And then buffer assets are just something that you don't treat as part of the investment portfolio, that you can use temporarily to cover spending to protect the portfolio after a market downturn. So that could be just having cash that you don't really treat as part of your portfolio. It's just this buffer. If there's a big market downturn, I'll spend from my cash pile for a couple of years, that sort of thing. In the United States, the other two buffer assets, which again, internationally may vary, but the idea of a reverse mortgage with a growing line of credit, or the idea of permanent life insurance with a growing cash value, can also both reflect buffer assets because they're protected from declining in value. So they're not correlated with the stock market. And again, it's just that resource to cover spending temporarily during market downturns.
In your paper named The Yin and Yang of Retirement Income Philosophies, you introduce the concept of safety first principle versus the safe withdrawal rate, which works more like a probability-based approach. Can you explain the main differences between the two approaches?
Sure. And so this is something I've been writing about since about 2012, this idea of the probability-based approach versus the safety first approach. And just in the past year, Alex Murguia and I have done research in terms of creating survey questions to better understand people's retirement income styles. And so the newest iteration of that is helping to determine a retirement style. And the two factors that we found to be most important or most distinct in explaining how someone thinks about retirement, one of them we did name probability-based versus safety first. So if you're probability-based, you're comfortable relying on the stock market. You're comfortable relying on the idea that stocks will outperform bonds, and you can spend from that and support a higher standard of living that way. If you're safety first, you're nervous about relying on the stock market. You'd really prefer some sort of contractual protection, something that there's a guarantee that you'll receive these spending levels. And whether that's holding individual bonds to their maturity, or whether that's using annuities within a contract through an insurance company, those are both ways to get contractually protected income that, at least when it comes to meeting your essential spending, you really feel more comfortable having that contractual protection in place. So that's how I think about probability-based versus safety first before, or now. Before, those terms just expanded everything. But now the other important characteristic to think about styles that we found was it's this idea of optionality versus commitment. Are you someone who wants to keep your options open as much as possible to make changes, to respond to new situations and so forth? Or are you someone who really feels more comfortable committing to a strategy that you know will work, that will solve your lifetime retirement spending need. And then you don't have to be as worried about it in the future. So the different combinations of, if you're someone who follows the Bill Bengen style 4% rule, that I used to call probability-based, well, that is probability-based and optionality-oriented. You're comfortable relying on the market. You want to keep your options open as much as possible. If you're somebody who is more safety-first and commitment-oriented, that's more of an income protection strategy where you'd rather have some sort of lifetime income annuity to cover your basic spending and then invest on top of that for the more discretionary types of expenses, but not have your whole retirement plan dependent upon good stock market performance. And at the same time, not feeling as much need to purely keep your options open because you have that comfort of committing to a strategy that contractually, will meet your lifetime spending need. So that's the basic idea there of those are the two extreme strategies. And then you have time segmentation, or what I call risk wrap, which are more behavioral type strategies that meld those characteristics in the less common ways.
Unfortunately, here in Romania, we do not have access to annuities or reverse mortgages. Of course, annuities don't protect us from hyperinflation, but are a good layer of protection against sequence of return risk. If we were to implement the safety first principle instead of safe withdrawal rates, do you think one should consider bucket strategy as an alternative? And what about reverse mortgages? Should we instead sell our equity in our home and pay rent in retirement instead?
Right. So the probability-based approach, comfortable relying on market growth, and then optionality-oriented gives you that sort of total return strategy. The bucket strategy is you like contractual protections, but you want to keep your options open. So that's where something like a bond tent, you're getting the contractually protected income, at least in the short term, through the bonds, and then you have stocks for the longer term expenses. So if you have that's a style. If you like to keep your options open, but you also have a preference for contractual protections or having contractually protected income, you might look at that type of bond tent, time segmentation, bucketing style approach to achieve that. That is more of a behavioral strategy because the natural correlations are probability-based goes with optionality, safety first goes with commitment. So it's if you're safety first but optionality, that's the time segmentation. And so if that's your style, then that would be the way to go. Now on the reverse mortgage question, the issue there is, so there may not be an actual reverse mortgage, but a lot of retirees have a huge amount of their assets in their home. And that home is not a diversified asset. It's a risky asset because home prices can decline. They can go up, but they can also go down. And you don't have the benefit, like if you hold a stock mutual fund, you're diversified across a lot of individual stocks. With an individual home, it's like you own an individual stock. You're much more exposed to the types of risks that can impact that individual home. So the reverse mortgage in the United States gives a way to spend that home equity and to not have that. You don't have to worry about how the home price evolves in the future because you have this growing line of credit that can potentially, if the home price declines, be worth more than the value of the home. Now, if you don't have an option like that, right, then your question is, what do you do with your home equity? You can just continue to live in the home and just have that sort of undiversified large asset as part of your balance sheet. You could potentially downsize, which may be an option of just purchasing a less expensive home, selling that home, purchasing a less expensive home, which if you've had children that are now grown and so forth, you may not need as much space, or you may not need to live as close to the city center. If you did that for work before, you might be able to move further away from the train lines and so forth. And that could lead to a less expensive home. And that would free up some of the home equity because if you now have a home that doesn't cost as much, the rest can now go into your investment portfolio or can otherwise be available to cover other retirement spending. Or like you said as well, you could simply sell the home and then rent. And I think that can also be an option as well, where implicitly when you own the home, it's providing you a rent or it's providing you a place to live that you otherwise would have to pay for. And you can look at the comparisons of, well, if I free up all that home equity, how much would the rent cost? And is that a reasonable yield off of the home equity that if I just invested that home equity as part of my overall investment portfolio, but now my expenses are a bit higher because I have to cover rent payments? Well, is that a worthwhile approach? And that can really depend on a case-by-case basis. But yeah, it can certainly be an option worth looking at as another way to free up the home equity and invest it in a more diversified overall approach.
Yeah, I'm thinking about this because unfortunately Romanians don't have financial education, and the home ownership rate in Romania is 96%. So basically, we store most of our assets in real estate and cash, and we don't invest. I think less than 1% of Romanians invest. And I was thinking whether wouldn't be a better idea to simply sell your equity in your home so you have a larger pot right now in the markets, but you also somehow increase your sequence of return risk because you also have to pay rent now. So it's tricky.
Yeah, and the rent could be exposed to inflation, but also the property or real estate taxes may be exposed to inflation as well. So that's a trade-off. Now, if someone's never invested before, it might ultimately be riskier. Even though the home is a risky asset, it might ultimately be riskier to sell it and then invest it. When you don't have much experience, you might make mistakes as well that lead to a drop or reduction of assets. So that would be another consideration. People without much financial literacy or investing experience might be better off having the home as their primary asset to hold their wealth.
It's very interesting because real estate investing in Romania is not diversified, but at least people don't see that volatility and they don't do mistakes. Because I heard someone saying that he wants to sell his pension fund to invest in Bitcoin. And imagine if all people do this. I mean, they will eventually get nothing. And I think emotional decisions also should be taken into account. What people do with their money if they see the stock market decline and sell everything. I mean, that is a risk also, right?
Right. If they're not an experienced investor, they can get themselves into more trouble. And yeah, I worry about a home being a risky asset, but it's probably, for the most part, a lot less risky than putting that same value into Bitcoin or some other highly speculative investment that could lose 90% or more of its value. And get, if with the behavioral side of that, if someone then panics and sells it, they've now created a situation where it's somewhat irreversible. So yeah, that would be a point in favor of keeping the wealth inside of the home equity.
Which is your default static asset allocation for a traditional versus early retiree in the new normal? And also, we always think about safe withdrawal rates as being the worst case scenario, but it doesn't have to always happen, right? So, which should be the median portfolio value for someone who spends conservatively at the end of his retirement?
Yeah, right. That spend conservatively strategy is not really a very good strategy. It's designed to protect you in worst case scenarios. But if you're not in a worst case scenario, your money just continues to grow and grow throughout retirement. And so your assets can often grow, at least when we look at the historical data about the 4% rule in the US. If you use the 4% rule historically, it protected you in the worst case scenario, but in the median outcome, your initial retirement wealth maintained itself in purchasing power. And if you didn't account for the inflation impact, almost all the time, if you started retirement with $1 million, you'd still have $1 million at the end of retirement. So it does a very poor job of just adjusting to how the evolving experience in retirement. That's back to that earlier point of using spending flexibility can just add so much more efficiency to the retirement plan because it helps to manage sequence risk by cutting back if markets are doing poorly. Well, at the same time, it allows you to spend more when markets are doing well. And so you can more efficiently spend down your wealth and enjoy it throughout retirement by moving away from a strategy that just doesn't respond or evolve to how the markets are doing in retirement.
So basically, which should be a default asset allocation in this environment?
So the 4% rule in the US Bill Bengen in his original article said, hold 75% stocks and in no circumstances less than 50% stocks. I did a study of the 4% rule around the world there's the global returns data, the Stimson, I think I'm getting the names wrong. Stimson, Staunton, Marsh global returns data. It's now for 20 different developed market countries going back to 1900. And so I looked at safe withdrawal rates around the world. And as I recall, for 18 of the 20 countries, the optimal equity allocation was at least 50% stocks. So it kind of paralleled what Bill Bengen found with the US historical data. I think there was one country that had like 30% stocks. And then, I don't remember. It's been a while since I looked at that. It's in some of my past writings. But yeah, it speaks to if you're going to use that sort of spend conservatively strategy, the default asset allocation has to be somewhat aggressive because you need that risk premium. And especially right now, as interest rates are low, you can figure out more directly how much you can spend from a bond portfolio. And it's not very much in a low interest rate environment. And so with the inflation risk and with just the desire to spend more than bonds can support, it does push you into default stock allocations. Again, not just in US data, but around the world of really at least 50% stocks for that sort of probability-based, optionality-oriented total return strategy.
I think that from the research you mentioned in the Global Returns Yearbook, a 70-30 portfolio was expected to bring 2% inflation adjusted for the future, so a very low return moving forward.
Oh, the expected returns on with the low interest rates, high valuations. That's back to you don't necessarily adjust your asset allocation when valuations are high, but you should at least anticipate a lower future market return, and that's what that would reflect if they're saying a 2% return on a 70-30 portfolio in the future.
Yeah, this is why I don't understand why William Bengen says that you should lower your equity allocation in this environment, because how do you cover inflation and spending if not from bonds which offer negative returns? Then you need equities, right?
Right. It's with that sort of approach, you really need equities. You can figure out the withdrawal rate on a bond portfolio just with the yield curve. And now with inflation, that's an issue. If you don't have inflation protected bonds, you can assume an inflation rate and figure out how much you can spend. But with the realization that if inflation is higher than that, you're going to run out of money sooner. But in today's interest rate environment, the safe withdrawal rate from bonds is going to be well below 4%. Depending on your inflation assumptions, it can be even under 3% for a 30-year retirement horizon. So indeed, that's where to have any shot at spending more than that, if you're not going to use things like annuities, or if they're not even an option, you're kind of pushed into holding a more aggressive equity allocation as the only alternative.
Even in retirement years, not only when you're young.
Right. Throughout your retirement years as well.
If you need to take on more risk for your equity portfolio to reach your retirement goals, what would you choose between investing in riskier assets like emerging market equities and levering a market cap weighted index fund?
You've got some flexibility there. Your core holding would generally be like a total market portfolio. So like a total return equity, like total market index fund. If you want to tilt away from that because you believe there could be an additional premium available for either like value investing or for small cap stocks or for stocks with greater profitability potential and so forth, you might decide to invest a small portion in those sectors of the market that you expect to have a higher long-term return. But you don't necessarily want to put all your money into those sectors because the volatility and risk is usually much higher as well. So it's more have a core holding of the total market and then potentially tilt towards some of those other factors that you think may give you a higher expected return over the long term.
do you think that if you invest, let's say, in riskier assets which have higher expected returns, the overall sequence of return risk is higher or lower?
It can be higher if it's all about the trade-off between returns and volatility. And even if the expected return is higher, it's a trade-off there. If the volatility is too much higher at the same time, that can lower the safe withdrawal rate. So it's the combination of returns and volatility that feed into what's a safe withdrawal rate. And more volatility it can lower the safe withdrawal rate because it creates more sequence of returns risk.
So this strategy might be useful in accumulation phase, but not in decumulation because it faces too many risks.
Well, yeah, certainly it would enhance the risk of when you're taking distributions for sure, right? Sequence risk is just simply when you have to sell assets at a loss to cover your spending needs. And so the more volatility there is, the more risk there is of having to sell assets at a loss to cover your spending needs. And that's what causes sequence of returns risk to be realized. So yes, more volatility leads to more sequence risk.
For those of us who want to reach financial independence, which do you consider being the default safe withdrawal rate that should be incorporated in financial planning? In his latest research, Bill Bengen has surprised everyone, considering 4.7% as being a new safe withdrawal rate.
So to be clear about that question, all this conversation about safe withdrawal rates is based only on a US investor. It's not meant to be applied internationally. And I still think I have one of the few studies that looked at international data. The original article I published in 2010, it was called the demise of the 4% rule, an international perspective on the 4% rule, something like that. And when I update that more to the present for a 50-50 portfolio, that 4% rule worked in the US and Canada, and that's it. It did not work in the other 18 countries in that data set. And when you looked at, what's the percentage of the time that the 4% rule worked around the world across all these countries' data, it worked 68% of the time around the world. And that's it worked 100% in the US, but 68% globally. And if you wanted a withdrawal rate that worked 90% of the time globally, you had to go down to 2.8%. So that whole conversation about the safe withdrawal rates really is just from the perspective of a US-based investor. And if an international investor is facing more volatility in their domestic markets or with some sort of currency hedging to invest globally as well, it's the combination of returns and volatility. And higher volatility can lead to a lower safe withdrawal rate. So I do think it's very hard to extend the conversation about the safe withdrawal rate front that's usually done just for US-based investors and apply that same number globally because conditions vary quite a bit globally. And the research that I did do about that just suggests that the 4% rule is based on the 20th century United States market performance. And it also worked in Canada, but this is a really unique period in world history where a country the 20th century US was a pretty remarkable century for any country at any point in history. And if you're just thinking more from a more typical international experience, there's no particular reason to believe that something like the 4% rule is quote unquote safe. So it probably for the most part would require thinking about the possibility of lower safe withdrawal rates. The 4% would not be the default for an international investor. It's going to be something lower than that.
Yeah, correct. I think you mentioned even 2.2% in a podcast.
That was based on, especially in March 2020, when, as part of the global pandemic, interest rates got so shockingly low. I think the 10-year Treasury in the United States was around 0.6%. And now it's closer to 1.5% again. So that helps. But indeed, when I ran the simulations based on where interest rates were in March 2020, I was getting numbers for a US-based investor just triggered by the low interest rates in the ballpark of 2.2%.
Right. What is your preferred choice for a dynamic spending rule to be used in retirement? A cake-based withdrawal rate or something else?
So that is an issue I've looked at in my book, How Much Can You Spend in Retirement? I compared 10 different variable spending strategies. And if you just pushed me for a favorite, I would have to say it's probably another rule. Actually, Bill Bengen isn't just the 4% rule. He also created a couple of variable spending strategies. And one was called, like I call it the Bengen floor and ceiling rule, where instead of using that initial spending rate and then adjusting that amount for inflation, you just use a percentage, take the percentage of what's left every year. So your spending fluctuates, but then you have a ceiling and a floor. And if taking a percentage, if your portfolio is growing, taking a percentage of what's left will eventually get you up to the ceiling, and then you just spend at that level. And if your portfolio is losing value, spending a percentage of what's left will get you down to the floor, and then you just spend at that level subsequently. So you have spending that will fluctuate in between a ceiling and a floor. And that helps manage sequence risk in such a way that you may be able to spend, even though you might have cuts, those cuts might not ever really push you much below where you would have been with just using something like the 4% rule logic, where you never adjust your spending in response to portfolio performance. So the Bengen floor and ceiling rule, it's one of the easier strategies, like variable spending strategies to implement. And I think it works pretty well. And so that would be where I'd suggest at least having an initial look. The other variable spending strategy, to just point out, that's the closest to being optimal from an academic perspective, is where you just take an increasing percentage of what's left every year based on the fact that as you get older, your remaining longevity is getting less. And so spend an increasing percentage of what's left every year. But that can lead to more variability in spending compared to something like Bengen's floor and ceiling rule, which gives you more of a compromise between you're adjusting your spending, but you're putting limits on how much you adjust it. And that's helping you manage sequence risk.
Don't you think that the cake-based safe withdrawal rate, where you use a formula with an intercept and a slope, would work better for reducing the volatility of withdrawals, and also that you take into account the valuation of the stock market?
So that, I don't know if I've actually really tested that, but you're saying apply the regression to the historical data on CAPE levels at the start of retirement, and then the withdrawal rate that ended up working for that retirement. And what you would find is when CAPE is low, you can use a higher withdrawal rate. When CAPE is high, you'd have to use a lower withdrawal rate. That's definitely a rule you could consider as well. I can't comment too much on it. The other issue there is, because that rule allows for variable spending, it fundamentally manages sequence risk better. Then you have to be careful how you derive the numbers, because if you just said historically, when CAPE is low, you use a higher withdrawal rate. When CAPE is high, you use a lower withdrawal rate. Well, that would be assume you always stick to that same withdrawal rate in the future. And the fact that you're actually adjusting that withdrawal rate means you could have been more aggressive before than through the ability to have that fluctuation. But yeah, I have no objection to
basically this formula works by updating it every month, so you can even withdraw on a monthly basis, and you don't need to, like in the 4% withdrawal rule, you don't need to be pegged to the initial amount for withdrawals. So you simply adjust based on what happens on the market. And from my research, it looks like being the best. I don't know exactly how the other rule would work, but I have to study more about it with the ceiling and the floor.
So a variable spending strategy where you just use a variable percentage of what's left based on the value of CAPE at that time.
So basically, you also update it every year, right? The amount from which you take the withdrawal.
Right. In practical terms, you could certainly do it on a monthly basis, but just as a research simplification, I usually just use an annual basis because it's not going to make that much different, and it just avoids the further complexities about having monthly adjustments instead of annual adjustments.
Sounds really interesting, this rule. Also, I would like to ask you, how can you reduce retirement risk with a rising equity glide path? And what happens if we are facing a secular bear market?
Mm-hmm. So the riskiest time to retire is you get a bear market in the early retirement years. And then a true worst case scenario is you have a terrible market for your entire retirement, but that you can't really plan for. So a more realistic worst case scenario is a bad market environment in the early retirement years, and then eventually markets recover. And so that would be the scenario that a rising equity glide path would help to manage that risk, because you have a lower stock allocation early on when you're experiencing the bear market, and then you raise your stock allocation so that later on when markets recover, you get some benefit from that. And so it's going to help manage retirement risk, because it's going to help protect the withdrawal rate in that sort of worst case scenario. And then in other scenarios, you won't be as well. Like, just compared to having a higher stock allocation throughout the whole retirement, if you have a bull market in the early retirement years and a bull market through the whole retirement, or you have a bull market early on and then markets subsequently do poorly, your strategy, you'll still meet your goal with the rising equity glide path, but you would not have as big of legacy value growth that way. So it's a risk management technique. You're going to leave behind less legacy when markets do really well in retirement, but you are going to better meet your spending goals when markets do poorly in the early retirement years. So that's the main justification for why we talk about that. And it's not necessarily that I recommend that as a strategy so much as it was just a point that instead of having a high stock allocation throughout the whole retirement, you can manage your risk by having a lower stock allocation early on and then just moving it back to what it would have otherwise been in a long retirement.
What if you are in the late part of accumulation? You should use maybe a U-shaped glide path.
Right. And that's what the target date funds in the United States do. It's the human capital argument. When you're young, you have a higher stock allocation. And then as you get closer to retirement, you lower the stock allocation. And then the question was always, well, what do you do post-retirement? And the target date funds didn't really address that. They either just kept the same low stock allocation throughout all of retirement, or they continued to decrease it throughout retirement. And that was in contrast to like Bill Bengen's research saying, no, you have to have a high stock allocation in retirement. So where the rising equity glide path came in to say is, we don't necessarily disagree with the pre-retirement advice. We just disagree with what target date funds are doing post-retirement. We think you should have more of that U-shaped lifetime stock allocation, where your lowest stock allocation is near the retirement date when you're the most exposed to sequence of returns risk. And then you can have a higher stock allocation when you're either younger or older in the life cycle.
There are many ways to construct glide path, from taking an active approach to a passive, and also using time-based or valuation-based triggers. Some even consider re-optimizing the glide path according to the Bellman principle of optimality. Like, for instance, if there is no more market downturn, why not being again defensive? And therefore, you could have more buffer assets for when the market declines. What do you think?
So I do tend to be more of a passive investor, which focuses on like finding a strategic asset allocation and then not really deviating from it too much. I did have that foray into looking at valuations, and I wasn't ever thinking of that as some sort of short-term market timing strategy, but more of a long-term strategy. I've since backed off of that because, again, I think when valuations are high, it's not so much that you should lower the stock allocation as it is you should just plan for lower returns in the future. So I think really just having that strategic allocation in place, at least for me as an investor, works better, and then not having to always be worried about trying to make adjustments to my asset allocation, and also the tax implications of doing that, or the transaction costs of actively trading investments. I'd rather just be more of a buy and hold investor. So I'm not necessarily familiar with all the different market timing techniques, because I do I do think more in terms of, as a long-term investor, find a strategic asset allocation and just stick with it.
So basically, do you think it is a mistake to reduce your equity allocation when markets are expensive?
Well, so again, in US historical data, you can find evidence of that working from like the 1870s through the 1990s, but not since then. Since then, it would have been a mistake, because if you follow that strategy, I think right around 1995 is when you would have decided to leave the stock market, or at least to substantially lower your stock allocation. And then during the financial crisis, you might have entered the market again briefly in 2009, but then pretty soon markets got overvalued to the point of you'd probably cut back again. So you would have spent the last 25 years having a lower stock allocation, and you would have missed out on everything that's happened. So there's kind of one of these principles of, once people figure out about a strategy that worked in the past, that's when it stops working. And so I have some concern that this sort of valuation-based strategy that again would have worked in the past, it stopped working once people started writing about it. And that was Schiller. Robert Schiller wrote his first, or I don't know the first one, but one of his important articles on this in 1997, which again isn't all that far removed from when these strategies really stopped working. So it's not necessarily a mistake. And certainly there can be an element of, if you've met your goals, you might want to take some of the risk off the table. Like if markets have been doing well, not only is the market more highly valued, but maybe you can lock in your goals and have a retirement success. So you might take risk off the table for that reason. But I would just suggest caution about the more general point of, because valuations are high, I'm going to lower my stock allocation for a while. It's just, that has, not that maybe that will be a winning strategy in the future, but it's not worked so well over the past 25 or so years.
In Romania, many people believe that you should simply choose dividend yielding stocks because they offer you passive income. Do you think someone should rely on dividends in retirement? And which are the main retirement risks of following this approach of dividend growth investing?
Mm-hmm. So I can mostly comment from the US perspective. I don't necessarily know how well this plays out with other international markets. But from the US perspective, like if you go into the total return market and not focus on dividend paying stocks, you may be able to achieve a higher total return than sometimes when you invest in more dividend paying stocks. It's riskier sectors of the market. You may have a higher dividend, but then you have a lower total return, because your total returns are your dividends plus the price returns. So maybe, like just a very simple example, the overall market might be a 2% dividend yield, but a 10% overall return. Maybe a dividend-focused approach gives you a 5% dividend yield, but maybe a 9% overall return. And so at the end of the day, you'd be better off with the total return approach that doesn't worry about tilting towards higher dividend-paying stocks. And then also, there's tax implications, at least in the US. If the dividends are not qualified, you're paying tax, like dividends, you have to pay taxes annually at ordinary income rates or at the preferential rates if it's a qualified dividend. But nonetheless, that money is coming out and you're having to pay taxes on it now, versus with capital gains, at least in the United States, you're not paying capital gains tax until it's realized, until you sell the investment. So you get more tax deferral through a total return approach that gives you more long-term capital gains and less dividends. So that would be another factor to consider. But generally speaking, I don't necessarily think it's wise, at least, and again, I can only speak to this in the United States, for investors to move away from the total market and emphasize more higher dividend yielding stocks as a way to generate income to fund their retirement.
Great answer. You have done some extensive research also on emerging markets pension systems during your stay in Japan. How sustainable do you think Romanian pension system is, considering the demographics, and what better alternatives do we have?
Yes, that's some research I did about 10 or 15 years ago, and I don't think I ever had a chance to specifically look at the Romanian pension system. the international trends, and it's not just public pensions, but also private pensions. It's easier for the employer or the government to promise a higher pension in the future as opposed to a higher salary today. And so many pension systems they're strapped with unsustainable rules in terms of not collecting enough contributions to pay for the future benefits that are being promised. So it's a trend around the world. I don't know the specifics on Romania. If you happen to know and can fill that in, if it's part of the international trend, it's just at some point you're going to need some sort of either dramatic benefit cut for the pension or a dramatic increase in the payroll taxes to fund that pension, or other tax revenues to fund that pension, because the promises are usually much higher than an actuary who tried to define, okay, what exactly do we need to collect to pay for these promises? Those actuaries would say, wait a second, you're promising way too much. And that's been the story with pension systems around the world.
As I said, most people in my country decide to invest in real estate because they consider as being a safer asset. Do you find real estate investing useful for managing sequence of return risk in retirement?
Well, it can be, and that's part of, if you have a stable rental income coming in, then you don't have to worry about capital gains or capital losses because you can fund your spending through the rental income. There are, of course, many issues with the complexities of being a real estate investor if you're actually owning properties and having to manage them, or whether you outsource that to a third-party management firm. But you have to worry about repairs and expenses associated with that, with the expenses of paying the management company to manage the properties, with the risk of having vacancies so that you're not collecting the rental income. Or if there's a financial downturn, maybe some of your renters are not able to pay their rents. And so you do have the sequence of returns risk there, because you're not, when the market downturn's happening, now your income is correlated with the overall markets because your renters can't pay their rents. So I don't think it's an obvious solution to sequence of returns risk for people who have the right mindset that they enjoy managing a portfolio of properties. It certainly can be part of their retirement strategy, but I don't think it's the be-all, end-all solution to all the problems of managing retirement finances.
What about gold? Do you find it useful for improving safe withdrawal rates in retirement?
Gold is another one of those assets that can be volatile, and it's more speculative in nature. So I think you can certainly have a small allocation to it as part of an overall diversified investment portfolio. But it's not the type of asset that I would necessarily want to be highly invested in to fund my retirement because of the sequence risk, the volatility, if you have to sell some of the gold when it's temporarily depressed value, then you're being impacted by sequence of returns risks. So I don't necessarily think it's a solution either, but it can be part of, just like real estate. Don't put all your eggs in one basket, but it can be part of a well-diversified overall plan to fund retirement.
When do you consider that a young investor should start decumulating his portfolio? Should he do this suddenly or incrementally?
So the actual process of spending from the portfolio, that was the question?
Actually, lowering the risk. Sorry.
Like the asset allocation of when to start cutting back. As if you know you're going to retire in, say, 5 to 10 years, that's where, especially 5 years before retirement, sequence of returns risk also exists pre-retirement, because as you're saving over time, the market returns are impacting more of your savings as you get closer to retirement. So I think, generally speaking, the 5 or 10 year window before somebody retires is kind of that nice transition period where they can start thinking about taking some of the risk off the table and so forth as a way to transition into retirement.
So, assuming you are 10 years until early retirement and given equity valuation are expensive, which would be your overall strategy for alleviating sequence of return risk in both late accumulation and early retirement?
So for me, you already mentioned annuities are not available, so that limits the options. But I would be looking at, if valuations are high, I've had really good returns on my equities, I would sell some of the equities and put that into different types of annuities as a way to get that risk pooling to help manage the retirement expense. And that's the style that resonates with me. That's more of that commitment orientation, and then either simple income annuities or deferred annuities where you can still invest inside the annuity. Now, if that's not an option on the table, then your options become either that sort of bond tent or time segmentation or bucketing approach. And if that's the strategy that resonates with you, then it's more of a matter of, as I get closer to retirement, some of the money that I may just have invested in general bond funds, I reposition into individual bonds to fund the early years of retirement. If you're more that total return style of comfortable with the stock market, wanting to keep your options open, I guess like part of this discussion about the valuations and whether you should lower your stock allocation when valuations are high, that might be an indicator that you may not be a true probability-based person, because you're not necessarily comfortable relying on the stock market in the way that there are people that just dismiss the whole valuations argument as saying, well, you can't really predict the future. Historically, in US data, large cap US stocks outperform long-term government bonds by 6% a year on average. Now, the historical analysis of valuations would say when valuations are this high, the equity risk premium is going to be a lot lower in the future. If you buy into that argument, it might really mean you're not as probability-based, because a true probability-based person would say, who cares about these valuations? That's no prediction of the future. I think that the economy is strong and going to continue to do well. And so I'm comfortable continuing to invest in equities. And so that more of that probability-based approach would go ahead and continue with that sort of aggressive asset allocation approach, as they view it as the best way to fund their retirement.
How can we handle emotional biases during retirement when our human capital reaches zero and we have no buffer assets?
Well, that can definitely be a challenge. And so people who are more susceptible to these sort of behavioral biases, that makes them more vulnerable to relying on a total return investing strategy. So the time segmentation or the bucketing strategy, often that's presented as a way to help manage behavioral biases, because it will say, if I have that 5 or 10 year bond tent in place, I don't have to be worried about a stock market downturn, because I now have 5 or 10 years before I'm ever going to have to sell stocks. And maybe I'll feel more comfortable then saying, okay, in 5 or 10 years, I expect the market to recover. So that can be one way to manage the sort of behavioral issue of panicking during market downturns. Another can be the rising equity glide path can fit into that total returns environment where you just lower the stock allocation when you're more vulnerable. And then you don't have to be as exposed to that behavioral bias that would tell you to sell and panic after a market downturn. Otherwise, the more pure total return investor just figures out a way to manage that behavioral bias, whether it's continuing to look at historical data and saying, okay, there's been times in the past where things look really bad, but the market always recovers. And we even got a dose of that in the March 2020 when people's behavioral ability to stay the course was really tested by the significant rapid market downturns that happened around March of 2020. But at the same time, markets recovered so quickly from that if you made it through that and you didn't panic and you stayed the course with your strategy, you're much better off today than you were at that time. And so you see that happening repeatedly over and over throughout the historical data. And that might be the way, at least for me personally, that's how I manage that risk, because I'm fairly highly equity invested. And I do feel the stress of a major market downturn, but I just continue to tell myself markets will recover. I'm a long-term investor. And in the long run, I'll be better off with a higher equity allocation than not.
I know from your research you have done together with Michael Kitzes that you are a fan of the 30/70 equity glide path. And I'm curious why you haven't used a 30/100 equity glide path when using Monte Carlo simulations.
Actually, you can see in that original research article, we let you compare the initial stock allocation being anywhere from 0 to 100%, and then the final stock allocation being anywhere from 0 to 100%. We just use that 30% stocks up to 60% stocks as a case study example to compare against. Kind of the balance of Bill Bengen's advice would be just hold 60% stocks throughout retirement. So as a way to explain the basic point, we compared 60% stocks throughout retirement against start at 30% stocks and increase back up to 60% stocks. So it's not that it was really any sort of recommendation. It was really just more of a case study example to illustrate how the approach works. And then what somebody actually does in practice really depends on their risk tolerance and other factors. So I didn't mean for that to be a recommended strategy. It was really more just an example.
Yeah, but when you use Monte Carlo simulations, you don't take into account mean reversion. Do you think this approach of 30/70 equity glide path might be too conservative when thinking about real life events?
Right. So you're making an important point that for most of the basic Monte Carlo simulations that get used, it's called independent and identically distributed returns. That whatever happens this year doesn't impact future simulated returns. Whereas in real life, we do get a sense that there is mean reversion, that if there's a big market downturn, then in subsequent years, there's a higher chance of better returns to offset that. That's kind of the whole valuations argument. High market returns push up valuations, which is kind of like pushing against a rubber band that eventually is going to snap back into place. And so with actual mean reversion, that can offset some of the harms of a big market downturn that you don't necessarily see in the pure Monte Carlo simulations. So yeah, I mean, that's a fair point. I think we did also look at the rising equity glide path idea and just using the historical simulations as well, like Bill Bengen did for the 4% rule, which do pick up that historical mean reversion. And it was working both ways. But yeah, certainly a simple Monte Carlo approach might lead to a wider distribution of outcomes over time than reality, because in reality, you do tend to get pushed back towards the middle in a way that the Monte Carlo doesn't reflect.
I'm thinking that if you start very conservatively with only 30% in equities, perhaps you could become more aggressive in your late retirement, because eventually, if you have more than 10 years for your bond tent, let's say, equities on the long run should outperform bonds, right? So eventually, if you invest all your money in the asset with the highest expected return, that should be good for your legacy.
Yeah, in Monte Carlo simulations or in historical simulations, usually 100% stocks does the best. And even in the worst case scenarios, doesn't necessarily do that much worse. So there can be that argument to have a higher equity allocation throughout. One other point about the rising equity glide path, because it gets back to this valuations discussion, in a way, it's picking up that idea of valuations, because historically, bear markets happen after high valuation periods. So what the rising equity glide path is doing is actually lowering your stock allocation after a high valuation period, or at least that's where it's derived from, so that you then are less exposed to a market downturn. And then later on, you're increasing your stock allocation again. So it is picking up that concept, even though I say don't really adjust your stock allocation to valuations. But it's tested on historical data, and it's tested on Monte Carlo simulations where that phenomenon is present in the historical data. So that's part of the story of where the rising equity glide path came from.
Dr. Wade Pfau, we are very pleased you have joined us today in our investing podcast. In the end, which would be your final advice for those starting to plan for their financial retirement?
Well, it's always a matter of the basic principles in terms of save, don't spend more than you earn. And if you don't have that experience with investing, it definitely there are some behavioral biases that can impact new investors. So start to read up on investing. One of the classics that really helped me learn about like basic investing approaches was A Random Walk Down Wall Street by Burton Malkiel. So I definitely would recommend that book to your listeners who are just starting to learn about investing, because saving and investing is the way to benefit from compound interest and from growth over time, and to eventually you'll get to a point where the growth on your portfolio might be more than what you earned as salary that year. And that's going to help you speed up getting to financial independence all the more quickly. So learning those principles and applying them to investing becomes very important for those seeking financial independence.
Dr. Wade Pfau, let me applaud you for all your work you have done for retirees and also for the retirement income spending advice you have shared with us today. I would like to wish everyone a Merry Christmas, a Happy New Year, and may 2022 bring you all a wealthy retirement portfolio. Thank you very much for being with us today, and all the best. Thank you and take care. Bye bye.
Thank you.